Hello, my name is Ajay Tyagi and I am the head of equity at UTI Asset Management. The most commonly asked question by investors today is whether we are in an AI bubble, and if so, what impact will it have on global equity markets? While it's always difficult to predict cycles, but one can hold an informed view about where we stand in the current cycle. Most parallels are being drawn to the dot-com crash of early 2000s and the years leading up to it. The US equity market is not yet in a classic market-wide bubble, but it is in a bubble-prone AI capital expenditure supercycle. The current rally has far stronger earnings support than the dot-com bubble, but valuations, market concentration, narrative dominance, and capex extrapolation have moved into zones where forward returns are increasingly dependent on flawless execution by a small number of mega cap companies. To understand the dynamics of AI capex, comparison with previous tech cycles are warranted. If one looks at the current AI capex, the pace has large similarities to the internet era of the early 2000s. The internet boom too started with a build-out phase, somewhere around 1997 or 1998, when hardware infrastructure was being laid out, while the technology itself remained nascent with limited use cases and a high cost structure. Eventually, as is typical of most cycles, excesses build up along the way, leading to stretched balance sheets and poor incremental ROICs. The AI capex cycle is the dominant capital allocation story of the current era. The largest public hyperscalers accounted for approximately $400 billion in capital expenditure in 2025, nearly 70% higher than in 2024. Forecasts for 2026 are even more aggressive, with consensus estimates pointing to around $500 billion in capex for the hyperscaler group alone, representing around 34.6% of total S&P 500 capital spending. Putting this in historical context, AI capex has already reached the intensity we had witnessed in the late 1990s, when capex at a similar scale preceded a similar and significant impairment of returns. In the previous cycle, the capex to free cash flow ratio averaged about 85% in the 3 years leading up to the eventual meltdown in early 2000s. This time around, the ratio has remained significantly lower over the past few years, but is now tracking over 100% for the last few quarters, signaling a sharp increase in capex intensity. The key difference from 1999 is that today's hyperscalers are generating real cash flows, and the infrastructure build-out, at least so far, has been funded by operating earnings rather than any speculative capital market financing. The core debate is not about whether AI will matter, but whether the $500 billion annual infrastructure spend by the hyperscaler group alone will generate returns that justify the current market pricing. A survey of over 6,000 executives conducted by Goldman Sachs found that more than 80% of companies report no measurable productivity gains from AI, despite billions in investment. McKinsey's 2025 State of AI survey found only around 6% of respondents qualified as AI high performers, achieving 5% plus EBIT impact. And JP Morgan estimated in November 2025 that AI needs to generate over $600 billion in annual revenues just to achieve a 10% return on infrastructure investments. This is not an easy feat, as the asset base being built implies a revenue hurdle that has not yet been demonstrated at scale. If you look at the US tech capex as a percentage of GDP over the last 30 years, the present capex intensity has already surpassed what we witnessed during the tech bubble. Apart from the investment binge that is happening, the excitement around AI is also being reflected in the stock markets. If you look at the Philadelphia Semiconductor Index, also called as SOX, an index comprising of companies that are involved in design, distribution, manufacturing, and sale of semiconductors, the euphoria is evident. The index has more than doubled in the last 1 year alone. And that's not it. Similarly, the EU AI Power Index, which consists of EU listed stocks and is designed to measure the performance of AI infrastructure companies, is up by almost 75% in the last 1 year. Finally, the Bloomberg Global Memories Index, an index of memory companies, has gone up by a whopping 8 times over the last 1 year alone. During the dot-com era too, investor excitement towards hardware companies was extreme. Back then, the key hardware player was Cisco, which supplied routers and modems to sustain the internet boom, similar to what NVIDIA is today for the AI boom. Cisco's revenues and free cash flows increased multifold during the adoption phase, once again very similar to what NVIDIA is witnessing today. And as a result, Cisco's market cap reached 4% of S&P 500 market cap before correcting sharply. And here's what happened later. Even after waiting for more than a quarter of a century, it is still below its all-time highs. And just for reference, NVIDIA's current market cap is already more than 7% of S&P 500 market cap. Well, in conclusion, while history doesn't repeat itself, but it certainly rhymes. While each technology cycle has different utility and adoption curves, it does appear that markets are getting ahead of themselves on expectations of AI bringing in meaningful productivity gains and consequently improved profitability for businesses. Looking at the data, it does appear that we may already be in the late stages of the cycle. Peaking of AI capex amidst tariff wars and energy crisis related pressures could lead to heightened volatility and uncertainty in global markets. Thank you very much for your patient listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.